Hi guys, today we'll talk about two major views on investment, active investment and passive investment. We'll try to understand the advantages of each investment strategy, which one might be more suitable for your purposes, and who is right finally, Warren Buffett or Peter Lynch and Michael Burry. Also, we'll try to find out finally what's the difference between mutual funds, indices, index funds and ETFs. But before we jump right in, don't forget to hit this like button down below and subscribe to my channel if you like the video. Index reflects the performance of a group of securities of stock market, so this could be bonds or stocks. One example of an index is FTSE 100, which reflects the performance of 100 largest companies in the UK. Another example is probably the most popular is S&P 500, which reflects the performance of 500 largest companies in the US. So index funds are quite similar to ETFs. They both indicate portfolio that matches a specific index like FTSE 100 or S&P 500. The major difference between ETFs and index funds is that ETFs can be traded throughout the day like we are used to with stocks, but index funds can only be bought and sold for the prices set at the end of the trading day. The major advantage of ETFs and index funds is low operating costs. It requires very little management, so you're literally tracking the index as it is. Even if some companies join the index or drop out of index, you're still just tracking this index and matching this index. So it doesn't require anyone, a group of analysts sitting in the office, buying and selling stock on a daily or monthly basis. It's literally just looking at the index and doing what the index does. Index funds is the most passive investment strategy possible. It's based on buy and hold approach, which means you're buying it now and holding it for longer time periods like 10 or 20 years. The second principle is diversification of assets. So by diversifying across different sectors like 500 biggest companies in the US, it doesn't consider only tech sector or only agricultural sector. It's diversified across different sectors, even if it's within one country. So by doing this diversification, you're spreading the risk across different securities. Another major principle of index funds is you're trying to match the market, not beat the market. So according to this passive investment strategy, it's impossible to beat the market. The best you can do is match it and then just look at your investments grow over time. It's also based on the assumption of optimistic outlook for the markets, which means whatever happens now, if there's a recession, if markets are down 50% in the future, over time markets will still grow, so you'll still be in plus, you'll get some nice returns in the future anyway. The average expense ratio for index funds is about 0.2%, however it can go much lower. For example, one of the most popular index funds is Vanguard S&P 500 ETF, ticket symbol VOO, has an expense ratio of average 0.04% across 10 years. Also, there is a common misconception that all the ETFs are very safe and secure and nothing can happen to it. Of course, it does depend on the ETF. S&P 500 would be quite safe because it's large cap companies in the US, so quite developed market. But there are some others, for example, Vanguard Growth ETF, ticket symbol VUG, which is less safe because it's consists of growth companies, which means they are highly volatile, much more volatile than large cap companies. They can go up and down, they can even go bankrupt. So it's much less safe if you do want ETFs on a bit of a riskier side. There are some disadvantages of buying only index funds and ETFs, and the one that I find quite significant is there is no flexibility in terms of what you want to get into your index fund or get out of your index fund. Like you bought this S&P 500 index funds, that's 500 companies, and even if you know that one of them is definitely going to go down across the next years, in fact, if you're friends with CEO of the company and they told you the company is going bankrupt in 3 days, there is still nothing you can do to cut it out of your index fund. It's already there and it's gonna be there. Even if you don't believe in company, even if you didn't want to buy it, there is nothing you can do. If you want to buy a company that's not on your index fund, there is some flexibility. Obviously, you can just buy the stock unless you're a firm believer in the passive investment strategy and you're only buying ETFs or index funds. But if you're not, you can buy the company separately. However, this thing that you can't cut out the company is quite a big disadvantage to my opinion. Another disadvantage is there are normally no rising stars within index funds or ETFs. There are no great losses because it's diversified, it's spread over different companies, it's less risk, but again, it's less reward at the same time. If you do want to check out more high risk, high reward companies, watch my recent video on 4 best penny stocks to invest in. Next, we'll talk about mutual funds. Mutual fund is actively managed fund. That means there is a group of analysts sitting somewhere in the office, constantly getting the news and updates on the market and the company statistics, trying to understand which companies are good and bad, which ones to sell and which ones to buy. So they're trying to time the market at any given point to maximize the profit. The average expense ratio for mutual funds is about 1.4%. So as you can understand, running a mutual fund is pricey. You need all these transaction fees for constantly buying and selling the stocks. You need all the salaries of analysts. So it does cost more money than running ETFs or index funds. Additionally, it's very hard to actually outperform the market. In fact, in 2019, 71% of mutual funds underperformed S&P 500 index. So you'd ask yourself, why even bother paying these higher fees, all this buying and selling of stocks, if it's still not going to perform better than the market? The reason is it's higher risk, high reward kind of scenario. So there is a higher risk that you're gonna earn less than the market, less than from indices and ETFs. However, there is also some chance that you can get much more, like 30-40% rather than this 5% that ETFs and indexes normally give us. So looking at individual stocks, there are two major opinions in favor of this strategy, and those are by two very famous investors, Peter Lynch and Michael Burry. So let's first look at the Peter Lynch opinion. So Peter Lynch was a Fidelity Magellan's fund manager, and he is famous because of posting 29% annualized return over 13 years. He also increased his assets under management from 18 million in 1977 to 14 billion in 1990. He's the author of best-selling book One Up on Wall Street, which kind of became the Bible of investment. And he also retired at 46, living pretty good life after this, which does sound amazing for most of us. So Peter Lynch doesn't normally give a lot of interviews, and when he gave one about 2 years ago, it did gain a lot of attention. So what he said is the move to passive investment is a mistake, and investors who are going completely passive just buying ETFs and index funds are, quote, missing the boat, meaning they're actually missing on profits and returns that they could be gaining if they invested in mutual funds. We need to take this announcement with a pinch of salt, just because Peter Lynch was a fund manager in a mutual fund, so he obviously is biased in this way, but to be fair, he was one of the best fund managers and he did post this 29% annualized return, so maybe from him it doesn't sound that bad at all. Another investor who has an opinion about this active versus passive investment strategy is Michael Burry. Michael Burry predicted housing market crash in 2008, long before anyone else could see signs of danger. He also predicted dot-com bubble in the beginning of 2000, and he's famous by the movie The Big Short that you might have seen before. It's a really good movie. If you haven't, I do advise to watch this one. So Michael Burry actually tweets quite a lot on Twitter. He keeps on deleting the Twitter and then creating it back to share his opinion, but his tweets are quite interesting. At the end of 2022, he shared an opinion that there is a passive investment bubble currently, so talking about index fund bubble and how it causes passive investments IQ drain. What he means by this is the investors don't do research anymore about the companies they're buying. And to be fair, if you do hold S&P 500, do you know what all these 500 companies are? I do hold some shares of this index, and I don't know what all these 500 companies are, and that is quite scary. Like, if we buy furniture to our home, we would carefully consider all the different brands, colors, sizes, materials, and then make a decision on buying the furniture. But now we just invest in hundreds and thousands of dollars into something we have no idea what it is. Literally don't know what's happening with these companies, what are their statistics, their fundamentals, so we're just throwing the money to nowhere. So now let's move on to the index fund view. About 80 to 90% of investors actually losing money trying to beat the market, and that's including the professional investors, so who have their 9-to-5 job as trading. They're constantly trying to time the market to buy and sell at the best time, and then even they are failing. In fact, the S&P 500 annualized return over the past 10 years was 14.7%, which is pretty hard to beat. And the biggest advocate for this index fund strategy, passive investment strategy, is Warren Buffett. In fact, he's been advocating for this strategy for years, and he's saying that most of investors are actually better off buying index funds rather than trying to time the market and buy the stocks that are good. Warren Buffett went as far as getting a $1 million bet with hedge funds on which investment strategy is better in the long run, active or passive. This was a 10-year bet, and Warren Buffett won the bet, so he did kind of prove that the passive investment strategy is better, that over the long run you'd still get more money if you just match in the market and not trying to beat the market. It's important for us to understand the dynamics of this 10-year bet to actually understand which strategy is better for you, dependent on your investment horizon and the current state of the financial cycle as well. Soon after start, Warren Buffett's hedge fund actually lost about 37% of its value compared to 23.9% of a hedge fund. Then from 2009 to 2014, Warren Buffett won in every single year. However, it still took him about 4 years to actually beat the hedge funds and then win the bet at the end of this 10-year bet. So in 2012, hedge funds were still winning in terms of their cumulative return. Also, it's important to note that in the previous investment cycle, from 2002 to 2007, hedge funds would actually beat the market with the 97% return compared to 64% return of Warren Buffett's index fund. According to Bloomberg, there's been a massive shift towards passive investments over the past 2 decades. So currently about 21.2% of all S&P 500 companies are held within passive funds. This is compared to 3.3% in 2003. In fact, Warren Buffett has been a major advocate of this passive investment, and in my opinion, he is part of the reason people are moving to passive investments. You can now hear about him everywhere. He's literally the most famous investor that's ever been, and everyone knows that his investment strategy is passive investment. So it does depend on your psychology and how much time you have. If you think you're the kind of person who would panic if stocks go down, if you don't have time to actually do proper research and evaluation of the company, or you don't have any will to do it and you just want to buy something to have your stocks and your money outbeat the inflation over these 10-20 years, then probably yes, passive investment strategy is the best for you. I'm gonna assume that if you are watching this channel, you're probably the kind of person who does like to know about the companies, do proper research, evaluation, analysis, and I link one of my videos down below for the best stocks to buy for 2023. Worth noting that Warren Buffett doesn't actually only hold ETFs himself. He has a very diversified portfolio of different companies. Some of them I will list here. So overall, if you do have small investment horizon like 2, 3, 5 years, and if we are in a recession, which we are in currently, it might be worth looking at active investment rather than passive, actually trying to time the market, because you can get very good returns, because you can buy very low and sell very high because of this volatility of the market. So it might be worth considering this investment strategy dependent on the financial cycle and your investment horizon. Now I want to share a bit of my opinion which strategy is better. I'm not a financial advisor, so you should do your research to decide where to invest your money into. I adapt a kind of actively passive or passively active strategy, so I actually hold both individual stocks and ETFs. I'm trying to diversify my portfolio as much as I can, including diversifying across different financial opinions. All of the investors I mentioned in this video are great investors, and they all have their opinions for a reason. I just think it does depend on your risk tolerance, age, financial horizon, multiple other factors, which strategy you actually want to adopt. So I'm trying to do value investment, which is something Warren Buffett and Peter Lynch both agreed upon. So if you do buy stocks, you should actually try to research properly on the stock, evaluate the stock, make sure you believe in stock's idea and that the company is gonna go up because you know what the company is actually doing. Warren Buffett and Peter Lynch actually did agree on one thing, which is never to invest borrowed money. So they both were against going short, and Michael Burry wouldn't probably agree with them after shorting the housing market, but I do agree with their opinion as well. I think you should actually have, not only you shouldn't invest borrowed money, you should have some money saved as a safety net before you actually move on to investing. So if you don't have any safety net for the time, if you lose your job for 3 or 4 months before finding a new one, I think you should actually start with a safety net before you even look at the investments. I do prefer, however, investing into individual stocks just because I enjoy researching the stocks, evaluating, trying to understand the company's goals and strategies, and trying to understand the financials to see which company share price is gonna go up. If you enjoyed the video, please hit the like button down below and subscribe to the channel for the YouTube algorithm so I can make more good videos for you in the future.